Welcome to our weekly market analysis. I hope everyone has had a good week and weekend. This analysis for November 4th, 2023. And in this week's analysis, we are going to review a few things. What happened last week? What a magnificent week. That was the best week of the year. But we have talked about that, and as you can see, it was end of October, and we've talked about the last 2 days of October and the first 2 days of November. The question is this beginning of a rally? This is the last 2 months of the year's rally, which are the best 2 months. What's going on? Or we want to really watch the bond market. Basically, interest rates were really guiding the factors for the markets going up. So it wasn't about really S&P and let's say Apple's earning. It was about interest rates dropping. So this is going to be a light week as far as economic news goes, but you will have quite a few central bankers around the globe will be talking, and of course there will be attention to Chairman Powell. I believe it's on Wednesday and Thursday when he will speak. So let's pay attention to that. And the dollar had one of its worst drops, especially on Friday. And the question is, obviously, this is interest rate related, and the lower dollar helps the markets. The question is this the beginning of an end that, at least in near term for dollar, are we going to go back to 100 or 101, or this is a little bit of consolidation? The last but not least, I want to pay attention to the financials. They had a great week. They were way outside their standard. We'll talk about expected moves. And perhaps the main reason I would say is the relief from these unrealized losses with their bond portfolio. So with the rates dropping so much, that was really a big relief. They had it down. Obviously, it has not been a very good year for financials so far. So those are the things we will discuss. And with that in mind, let's start with the economy. As always, we go under the hood. We look at the unemployments, and we look at the weekly retail sales, and also, again, the global commercial flights. We see that even with the concerns in the Middle East, is still there's a movement, and the flights are going on. Although month over month there's been some decline, but we are ahead of our 2019 numbers. As far as last week, it was a pretty busy week, as we talked about. Of course, there was the FOMC. The Fed talks. It was really non-event in some ways. The markets really expected that, and I think that would be interesting to see this coming week with Chairman Powell. The questions: did he sound dovish? Did he say that he was very adamant about not reducing rates, but is this the end? But on Friday, the non-farm payrolls kind of answered somewhat the question. The numbers came softer than it was expected. As we're going to dive in and do a little analysis of what really went on and what is our expectations for the coming months and next year based on these numbers. And again, this feels like a Goldilocks. The markets really liked what the Fed had done, and then also these unemployment numbers kind of helped them to have an excuse. Remember, the markets, October had not been a very positive month, so it was a negative month with all the other things going on. Of course, we're talking about the geopolitics. Still, while the things are happening in Gaza, but it's not to the extent that initially when the markets really expected it. But we don't know what is happening, under the hood. As I had said it before, we don't know what's going on behind the closed doors. So, but so far the market feels like, there's that control. And again, this was what the markets really liked with the softer numbers. So let's look at our the employment numbers, and this is what happened. And as I mentioned, the Fed and investors really liked that slower payroll growth. There was a slower wage growth and the higher unemployment number. Basically, what happens though, it is on one hand, it was good news, a slowdown, but would this be a recession? So is this a gradually, we are moving toward recession. So at this time, again, markets are looking at this as a Goldilocks. They feel that, it is the employment number is still good. As inflation comes under control, we're not gonna have a hard landing, but we shall see. As you will see, is the employment numbers are lagging indicators. So what happened was the non-farm payroll actually rose 150,000, while it was expected to be 180,000. So it was a little slower. But we have to take into consideration, we've had this UAW strike, which about 48,000 of workers were in a strike last month. So that has to be adjusted. And that was the most since 2004. But also there was some adjustments. The previous months were revised down by 101,000, which is about 80,000 comes from private sector. And the civilian employment, which is the jobs at like small business startups, they actually dropped 348,000 in October. And that's the weakest data point of all of that, is that total hours worked in the private sector actually fell to 0.3%. And if we do that, calculate the numbers, that could be equivalent to loss of 350,000 jobs. It's interesting how sometimes the bad news becomes the good news. Again, this was a relief for the markets. And we also had technical, again, there was a short squeeze, which we'll discuss a little more. The average hour earnings, it rose about 0.2% for the month. And it is, again, remember, we had the auto workers, which they're higher paid, they were absent. So that could have made a difference. So we're going to make that consideration. The inflation has declined, but also the increase in pay have declined. As of October, year over year, if we annualize it, we are up 4.1%. Last year, this time, we were up 4.9%. So what is happening now with the M2 measure of money supply is down versus a year ago, and the yield curve still inverted, as we shall see. Idea is we still have the short-term renters being attractive. So the risk aversion is still there for the businesses. So are they gonna, with this, again, uncertainty, are they gonna do any type of capital investments in their businesses? And if they don't, would that take us to recession? And again, remember, the labor markets are a lagging indicator. So next week, as I mentioned, just watch for the central bankers. The Bank of England, Governor Bailey will speak on Wednesday at 9:15 a.m. Again, these are Eastern time. We have the Fed Chair Powell will speak, and he will also speak Thursday. So there's quite a few speaking engagement. We also have the FOMC members, Jefferson speaks, and then Barr speaks. So we'll have quite a bit going around, but there's nothing really major. We have the consumer sentiment on Friday, but that's about it. So, and then we've talked about, again, the yield. So we still see there's a spread, the 2 years at 4.8, the 10-year, we touched at 5, went a little over that, and now we're at 4.55. We see the long end actually, moving up, but the 2-year, 10-year spread is still inverted. So, so what kind of a week it was? Again, it was the best week we've had this year. That the gold indices went up. Dow Jones was up 5%. Nasdaq was up 6.6%, and the S&P right about in the middle, about 5.94. So last week, if you recall, we were touching the correction zone. We were in the correction area, and now we are nicely, we only down like 4.4% for Dow, 5%, and 6% for S&P and Nasdaq. As a whole, the markets were up almost 6.1%, 6.05%. every part of, when we talk about looking at the different segments of the stock market, they were all up, especially the small caps, the small value, the micro cap. And the reason is, they've been hurt the most. Obviously, higher interest rates affect them the most. So that's been, again, they've been like risk off. But now this week we had all risk on, and they were the big benefactor of that. As far as the sentiment goes, you see that AAII, this is as a Wednesday. Remember, this is when we didn't have the employment number. We didn't have this 3 big day rallies. When we look at the Tuesday, you see it just started, but it wasn't. So this is the bulls were really on defense. They were down to 24.3%, while bears were on the move at 50.3%. When we look at CNN Fear and Greed, this, on the other hand, was as of Friday evening, and you see now the gauge has moved from, we were almost in extreme fear last week. We were at 27. We are moved to 42 and closer to neutral. Also, we look at the Citigroup panic euphoria. We see how we peaked in July, August, and now we are flattening. We are in the negative 1.4. So that's that cautious sentiment. Before we look at the markets, let's look at also our sectors. We see that the big winners came in real estate. And real estate, obviously, again, being interest rate sensitive, that really helped them. So that was important. The technology, the same thing. Financials, I talked about that. There was really a relief because of, as I mentioned, with the unrealized losses and mark-to-market. So consumer cyclicals, communication service, so everything was in green. But interesting thing is, we will look at more, but you can see just from this, these are the 2-month charts. We just broke above the 50-day moving average on Spider. But other things, when we look at the discretionary, we are below the 50. We look at the staples right below the 50. We look at the energy. The communication broke above the 50. The technology has been above the 50, but industrial is ahead against it, 50. The materials are right against the 50-day moving average. As I mentioned, the real estate, that was a huge move. They have been, look at those last 4 days, broke above 50. Financials also, and the utility. But the healthcare is against actually 20-day moving average. So just a food for thought. As far as, again, last week we discussed that, let's watch this as far as the Fibonacci 78.6. And we can see, we've touched that. That has been a big resistance, and then that became a support in the following 5 days. And that was important. We said, are we going to reverse? And we can see how it was a huge move again. That could be gamma squeeze, could be short squeeze, could be, again, as far as the end of October. I mentioned about the mutual funds. So we see how nicely it moved, and we just broke above the 50-day moving average, and we just broke above the last year August peak. So the question is, and that is the question next week, and we will dive in even more in depth. Are we in a mood to move back to the highs of July after breaking this 50-day? So it is important to the continuation. When we look at, I just want to look at the squeeze. You see the A wave just broke to the positive. LRC, I mean, this has been a huge move from -1 standard deviation. We are heading toward the +2 standard deviation. The momentum has changed, but the question is, would this, when we look at this, is this going to be a resistance right around here? If we break it, is that going to be continued? So basically, we've had this lower low, but we're still not in the higher high. So we've had the lower low, lower high, lower low, if we break this, then the trend could change. So it is an important week next week. As I said, a lot of earnings have been out, the big ones. We've had Apple last week on Thursday, which was not promising as far as the outlook goes. But other than that, basically, we still got some earnings that we will talk about, but it is that the catalysts are out. So basically, the markets are now going to pay attention, as I mentioned, to the central bankers, what they have to say. And of course, we still have the geopolitics going on. And diving in more, we can see this 100-day moving average is now coming as a resistance. We broke above the 18. We were oversold. We see MACD has moved. We see the stochastics are not overbought yet. The momentum is up. We're getting close to the overbought, but let's see. It has been a resistance in the past at 100-day moving average. And then when we look at on a weekly basis, we are against the 18-week moving average. But last week, again, I mentioned about this 100-week moving average. And the question was, we were right at it. And what's going to happen? In the past, we broke it. We tried to break it, went down. So we've been really floating around that 100-week moving average. This is a big bar. As I mentioned, this is one of the biggest weekly moves that we've had. So we are sandwiched between 18-week and 100-week. So this is important. Now, we are oversold. So let's see what this week will bring. A little dive in more, as I mentioned, that 100-week moving average, we are right on it. And this is a 200-week moving average. So I just want to show you a little more as far as the moving averages goes. NASDAQ is also similar to S&P. You can see the momentum is up. We see that MACD just crossed, but we are heading toward that 100-day moving average. When we look at the weekly, again, we bounce out of that 100-week moving average and we are oversold. As far as the Russell, that was the biggest move, which showed that small caps have been really beaten up. So if there was any short squeeze, this would have been the one. We broke above the 18-day now, but we are way below the 100-day. But the momentum is up and MACD crossed. So those are good news, but there's a lot of resistance coming. The same thing with the Dow. We are in an overbought zone, MACD crossed, but now we have nicely moved above 18. So we have the Bollinger Band and then 100-day waiting for us. On a weekly basis, the same thing. We are, again, going against 100-week and 18-week. So that's a big resistance. And we are embedded. So remember that on a weekly basis. When I looked at, again, we hit last week on the Dow, we hit the 200-week moving average and nicely bounced off that. So, but now basically we are against a 100-week moving average. And the transportation guidance is, we've said, they've been very weak. Finally, momentum is going up. MACD is just crossing and we broke above 18. So want to watch that. Of course, the lower prices in crude oil, that hasn't hurt. So that's important to realize. On a weekly basis, though, we broke below that 100 weekly moving average we talked about last week, went outside the Bollinger Band. We are embedded, but now we are against that 100-week moving average. So remember that. VIX, it was one of the sharpest moves down in VIX. We talked about hitting that upper end of Bollinger Bands. We had the divergence with the stochastics. So once we broke that, we knew the markets will move up. But now, basically, we are breaking below that 100-day moving average. This is pretty low. So we are oversold. So let's see, we're touching the Bollinger Band. So this will also give us a guidance, on the 15. And actually, I have my 1676. That was the support. So we broke below that. So if this is going to turn around, then that will give us a little guidance about the markets. The same thing happened on a weekly basis. we talked about last week also, we hit that 100-week moving average. So that was another indication that the markets could have a rally. So we had the seasonality, we had the short squeeze, I would say gamma squeeze, and also we could see VIX hitting the 100-week moving average. Now, momentum is down, and we were overbought, but we are now actually just the momentum down. The VVIX, a similar pattern in the sense that it hit the upper Bollinger Band and came down. When we look at the 10-year, that was really the catalyst. Look at, we hit over 5%, and that was a huge drop. We are now at 4.55%, that is music to the ears of, again, to the market, and they love it at this time. The question is, we just hit that Bollinger Band, and now are we gonna settle down in a sense, and is this gonna stabilize, or can we go lower? Obviously, if it goes lower, it's great from real estate to financials and basically technology, but these are crucial. So that's why I mentioned we're gonna watch the bond market. We can see the 10-year, for instance, right against it's a Bollinger Band, broke above the 18, overbought. So we really like to see this continuation. And when we look at the 30-year, it's the same thing. So it's overbought as well. The dollar, this was a big drop. So obviously lower interest rates, and what is happening in euro, what happened was it was a big drop. It helped obviously the markets as well, so, and emerging markets. So that was big drop. The question is, we are outside the Bollinger Band and we broke below the 18. Are the short sellers are gonna stop here and we'll have a little reversal, or this is going to be continuation going to the 100-day moving average? You see that EC did the opposite. It's outside the Bollinger Band as well, and broke above the 18-day. As far as gold, the gold has been really stabilizing now after the October 7th event. You see it has been really a hedge against any geopolitical event. So, and now basically we are really consolidating. The question is, even with the the dollar being so weak, there was not much movement in gold. With the lower interest rates, there wasn't. So are we getting tired? So I'll be a little conservative, but still, this is a part of your portfolio. It should be as a hedge. And we just moved to the overbought. So basically, if Monday or Sunday night we can turn around, then we still continue being embedded. So crucial points. You see MACD is almost to kiss. It's at the 12 and 26. So basically now they're still on the positive, and the 18 day moving average is crossing the 100-day. So that's the strength. When we look at silver, it has a 100-day moving average ahead, but it's bouncing off its 18-day moving average. But we do have some divergence, but MACD is still positive. When we look at the weekly, we see again a big resistance at 100-week and 18-week moving average. So be aware of that. And then copper broke above 18, is just railroading on its Bollinger Band. Bitcoin, well, what is happening? Remember, we were coiling. We've been talking about this, and we just broke out. We went outside Bollinger Band, came back inside. So again, this is more of anticipation that we will have the ETF based on cash basis rather than futures basis. So they are very positive this could happen. SEC is going to prove it. So it's the anticipation. So we see this positiveness, embeddedness in the Bitcoin. And last but not least, we see the crude oil really telling us that the Middle East events are contained at this time. And basically, we are just bouncing around that 100-day moving average. We're becoming embedded. We are oversold. We're becoming embedded, and we are under 18 days. So we are kind of sandwiched here. And when I look at the weekly, basically, again, we are right above that 100-week and 18-week moving average. All right. So one of the interesting things was expected moves last week, huge moves. And that's why I mentioned about the gamma squeeze. And with the expected move on SPX, it was supposed to be about 96. It was $240. So you see, this is really market makers it's driving them crazy. Look at this. I mean, that's amazing. It wasn't just only one, and it has happened before. Look at NASDAQ, the same thing, way outside. And we've talked about, again, the gamma squeezes. Look at IWM, the Russell 2000, huge moves. The Dow Jones. Now, this is the question we should have is you can see the TLT, the ETF of the 20-year bonds. It's like, this almost looks like a head and shoulder, but it is the shoulder. Are we going to come down? And then it's important to see if we can break this area. And we see we got rejected. So we are still outside that expected move. And on the other hand, the dollar, hit the upper edge, and we just broke below another one outside this expected move. Now, gold was orderly. We hit that lower edge, moved up, and it was a good news. Obviously, the unemployment, the way it came, and the lower rates, and the dollar down. So it was helpful on Friday for gold. Silver also had a nice move. And we look at the financials. As I mentioned, that was a huge move. Look at that, way outside its expected move. Energy did go outside and then came back and closed right up inside this expected move. Now, it was end of October, so as every month, as you know, I like to just give you how the October performance was. We'll start with the 1 month and coffee. We have talked about coffee, I think a few weeks ago I talked about it. So they were the best performer. Gold was also up nicely. And basically, that's for your information. Year to date, orange juice is up 125%, followed by sugar and cocoa, and then NASDAQ. As far as the currencies, and you can see Bitcoin is the hot one, end of October, and then British pound yen. That was another big winner, and the dollar yen was big winners. Just mentioned as far as this is the sectors. This is end of October. You can see how things completely changed. And when you look at the performance year to date, so the communication services and the technology have been the big winners. As far as the industries goes, I wanted to see what was the worst performing industry. Has been solar for year to date, as you can see, and performance for the month, and then pharmaceutical retailers, believe it or not, silver, aluminum, and wheat. But this was end of October, and it's amazing how the following 3 days things completely changed. The best performance for end of the month, for October, end of the year, year to date, has been uranium, internet, content, and semiconductors. As far as once we look at the individual S&P 500 stocks, you see how they perform for October. For October, you see Microsoft was a winner, and because of the good earnings they had. But then you see Google, NVIDIA, Apple, Tesla. So they were performance for the 1 month. Of course, year to date, I want to pay attention to that because it's part of our lesson of the week also. We will look at this. Look at these numbers. NVIDIA is still being down for the month. They're up 179%, 41%, 31%, 41, 58, 63, 150 percent. And we have Eli Lilly at 51. So you look at this year to date and you say, wait a minute, look at all these big greens and then a lot of red when we look at other stocks. So we'll discuss that. Exchange traded funds for the month, you see S&P the Nasdaq and Dow, they all were down. So inverse ETFs were up. The gold miners were up. Gold was up. Junior gold miners were up, and the short of semiconductors were up. But year to date, on the other hand, you see obviously indices up. Dow was flat. So that's again, that changed this week, by the way. So, but semiconductors are up, technology. So as far as the world goes, that's for the month. You see Alibaba and Taiwan Semiconductor, Toyota, and then JD.com. So this is just a different continent. So what has happened, a lot of banks in Canada, they were down. And year to date, again, you see a lot of green in Europe. So, and again, in Asia, there's some in, when you look at the Taiwan Semiconductor, Toyota Motors. And then I also want to do a little look at some fundamental analysis, the price earning to growth, and compare all the stocks in S&P 500. So we see like Meta is actually 0.82, it's PE to its growth. So even NVIDIA, it's a nice, and then Google, and then Apple actually doesn't look good. So we look at the oil companies such as Exxon or GE in the industrial, Berkshire Hathaway, Bank of America. So just a little, again, fundamental forward PE, looking for how the valuation is going as far as looking at the projected PEs. You see where all the big mega companies are standing. And of course, financials obviously have been beaten up. So they look more attractive at that point. So with that in mind, I hope that was helpful. What we're going to do, we're going to go to our next segment and look at our emerging markets and lesson of the week. Thank you so much, and we'll talk to you soon. Bye.